Welcome to Markets Now. I'm Michelle Rook along with Ted Seifried with Zaner Ag Hedge. We started off with higher grains, but now soybeans have kind of started to trail off over in the livestock futures. Cattle still higher. We're mixed in the hogs with those nearby contracts under a little pressure. So I got to ask, first of all, soybeans had a big run up yesterday, some follow through this morning, but we're setting back in beans right now. Is it just some profit taking? I mean, did we just hit chart resistance or what?
Oh, well, we did hit chart resistance, so there's no doubt about that. We have a series of highs up here for those November beans between 1360 and 1380. So this is going to be a difficult area to crack through to the upside. And I'm not saying that we can't do it, but we're still going to have resistance here. A couple other things, though, like yesterday, a lot of yesterday's strength was accounted for by rumors of Chinese buying of soybeans. I couldn't confirm that, and I'm not actually sure that actually happened. But the trade was hoping that we would see a really nice daily flash sale to China this morning, and we didn't. So I think there is some disappointment in that. I think that's part of the reason why we're a little bit softer in beans today and couldn't hold on to that early strength that we had in the overnight session. And right on the open, we actually kind of started to come under pressure. But then also, it's a bit of a risk off day, right? And you look at crude oil now, giving back crude oil looking like it might be near term toppy. That's putting pressure on soybean oil. Soybean oil is down a little bit today. So the overall market climate and the weakness in crude oil, I think, is filtering into the soybeans as well. So yeah, we're cooling off a little bit of yesterday's gains. In the great scheme of things, though, Michelle, we are sitting up near recent highs in soybeans, and we are now sort of consolidating at this level. So the question is, where do we go from here?
Right.
And I think a lot of that's going to have to do with weather, but we'll see.
Yeah. Are we going to have a weather problem here in August to get back above, say, that $14 mark in November beans, or what's your thoughts?
Yeah. You can look at weather two ways right now. For one, the drought monitor that we saw that was updated yesterday didn't show a whole lot of improvement, at least not as much improvement, I think, as some of us were expecting after the rains that we have gotten. And then when you look at the 6 to 10 and 8 to 14 day forecasts, I mean, at least, from NOAA, there's not a tremendous amount of rain in there. You're looking at pretty much normal chances for the 6 to 10, and then a big portion of the area looking for below normal chances in the 8 to 14. And that actually is coming right during tasseling for corn, or during pollination for corn, which I think is part of the strength that we saw in corn yesterday and the follow-through strength that we're seeing today. But I don't know if the weather problem has been fixed yet. Yes, it's a better weather pattern. It is a different weather pattern. We're getting rain in places that we hadn't been able to get rain for 3 months. But is it enough? Is it enough to fix the deficits that we had going in? And we'll have to see. I'm not exactly sure what it's going to look like going into August for soybeans. That's their all-important time frame, as you know. Right. I think there's enough of a reason to believe that, or maybe not believe, but be concerned that weather might not be perfect for beans to hit that 52 national average yield, which we really desperately need to have a balance sheet that's not ridiculously tight, or at least tighter than what we've been seeing in the last couple of years while we've been enjoying these high prices.
Yeah. The debate on yield also rages here in corn. We did get that 4 bushel per acre cut from USDA, but is the trade feeling like we need a bigger cut, or a bigger cut is coming? Is that why we're continuing to be up today, or are we getting help from wheat, or the talk of the Black Sea grain deal not being extended? What's going on there?
All the above, Michelle. All the above. And it's interesting, yesterday when the report came out and the USDA lowered yield by 4 bushels an acre, as you pointed out, I think the trade was a little disappointed that they didn't do more. But then, a lot of the analysts that know how the USDA does these reports, you listen to their commentary, and you realize that the USDA doesn't change corn yield in the month of July unless one of two things happens. And the more common one, the one that we've seen in the past in 2013 and 2019, is when you have delayed plantings.
Right.
And by the way, I should say the USDA doesn't change corn yield before August unless one of two things happens, because it doesn't have to come in July. But we didn't have delayed plantings. That would be the main trigger for them to lower corn yield before August. That was not the case this year.
But we've done it in 2012 because of drought, right?
Yeah, that is true. So in 2012, we did it because of drought. in 2013, the USDA changed their model on how they forecast corn yield. So since 2013, and that's a very good point, Michelle. There is a very big differentiation between pre-2013 and post-2013.
Okay.
When they made their changes in 2013, a dry July, a dry June can only trigger a lower corn yield in the July WASDE report based on one thing, and that is if we're below in the bottom 10% driest Junes that we have on record. And 88 makes it a real tough ask to have it in that bottom 10%. And we weren't quite there. We were a percentage or two off of that. But they did it anyways. And I think a day removed from the report, when we came back in the next day, I think the market was feeling, hey, they actually did lower yield in July when maybe they shouldn't have. And maybe that's a signal that the yield number might be coming down even more. And then on top of that, we got that drought monitor that didn't improve at least as much as I think a lot of us had expected. And then, put that together with the 6 to 10 and 8 to 14 day outlooks. And you say, oh, wow, yeah, maybe this yield does come down quite a bit more. So I think there was a number of things that went into the strength that we saw yesterday and the follow-through strength that we have now. But I think a lot of that is the fact that the USDA did lower yield on a July report. And again, that drought monitor and the weather forecasts aren't necessarily conducive to a massive improvement in conditions.
Yeah. So folks are thinking we have some bigger cuts coming ahead. Okay. So wheat market, we talked about the grain deal not being extended as supportive, but are we putting weather premium in, especially in those spring wheat areas? Because it's dry from the northern plains up to Canada.
Yeah. And it looks like, a lot of the weather forecasters you listen to, and even if you look, just the NOAA, the very basic NOAA weather maps, that's going to be the sort of problem area that we're going to have. So yeah, I think spring wheat does have reason to put in a bit more of a weather premium. Your winter wheat, I think ended up being a lot better crop than what a lot of people expected. And you're going to see a little bit more harvest pressure. We're not done with that yet. So I think it's going to struggle there. Chicago and Kansas City are going to have a bit of a difficulty. But, like you said, that grain deal, what happens with that, right? Are we going to last minute, is it going to change? Is it going to happen again? Like we've seen in the past, right? I think it's hard for the market to believe that deal isn't going to happen, even though it sounds very much like it might not. I don't know. I think the market has to be skeptical about that because, again, we've gotten to the 11th hour before and then it does happen. But at least for the moment, it is supportive for the market. And, hey, if that doesn't happen, I think that's more supportive for corn than anything else because China has been buying the vast majority of their corn from the Ukraine. And so, yeah, corn and wheat would really benefit from something like that.
Cattle market is back higher here today. And where do we have to close to negate the key reversals from Wednesday in live cattle futures?
Yeah.
And does it matter when we're this supply tight?
Yeah.
Talk about this. How many key reversals have we had, Ted?
Yeah. The really big one came at the beginning of June. And that was a decisive key reversal. There was no argument about whether it was or wasn't. It absolutely was. And I've said a bunch of times in the past that key reversals, in my opinion, aren't necessarily a top or a bottom to the market. They're a warning sign, of a red flag saying that, hey, this could be getting towards the end of the move. This could be getting towards exhaustion, right? And I think that could be the case. But, I'm not seeing the key reversal on Wednesday because I'm now using, I'm really focused on the October is my charting source.
Okay, instead of
and we came just short of the low that we had from the previous day. So we saved that key reversal. In my book, we did just barely, right? But it is another warning flag. Whenever you get up into new contract highs like that and then fail and come down and close near your lows, that's a bit of a problem. Now, the good news is that we followed it up on Thursday with some weakness early, but we were able to bounce back near unchanged by the end of the day. So that was good. And now we're finding some strength again today. In fact, if we close, where we're trading right now, we're threatened to put in a new contract high close for that October live cattle. So I don't think this is the end quite yet, but there are some warning signs, both on a chart, as we talked about, and I think on the fundamental side of things that, we could be getting to the end of this for now, meaning a deeper correction, or we could be getting to the end of this like the end. And again, I don't think it's quite yet, but you look at cash cattle. It was strong, then it cooled off again, and then it started getting strong again. We're going to start putting a lot of pressure on Packers margins, I think. Seasonally, box beef prices come down this time of year. Once we get
And they
past
have been.
the peak July 4th, demand weekend. Between that and Labor Day, we kind of soften our demand a little bit. Everybody's had their fun at the beginning of the summer. We get out and we want to grill and be out and it's like gangbusters, right? But then we get into the summer doldrums where things kind of start to slow down. We've spent a lot of money. Again, we've had our fun. It starts getting, a little bit hotter and a little bit less comfortable to be outside, especially when you're grilling, things like that. And we see demand soften a little bit in the middle of the summer. That's what we're seeing right now. The box beef prices have reflected that. So we're seeing that seasonality. That's going to put pressure on Packers margins, which means that maybe the advance in the cash cattle that we've seen in the last couple of weeks might start to slow down as well. And if that happens, it's going to be tough to justify continued strength on the board. It's possible, but I don't know. I think we should see a cooling off of these markets. Now, whether we regain that strength and make new highs as we get into the fall or not, I think has a lot to do with, weights, cattle on feed. What our placements are going to be going forward. Watch the feeder cattle market. Feeder cattle market, I think, is showing more signs than the live cattle market is that we could be near-term toppy. And I think that's something that the cattle guys really need to pay attention to.
Yeah, we're looking like we're going to have a lower weekly close in the feeders. That's for sure. Hog market, we've had quite a run off the lows, off the contract lows here. It's gone farther than a lot of us thought it was going to go here past the July 1st Prop 12 date. Cash and cutouts have still been strong. Can we keep going?
Yeah, so it's the opposite for hogs, right? Domestic demand seems pretty good. Cash cutouts are rather strong, and I think it's about time for that. I think what we're finally seeing is that people are maybe saying, hey, pork is really pretty cheap compared to the high priced beef that we're seeing at the butcher's counter. I think there's more interest in that, and I think that's a good thing. I've been waiting for that to happen. The effects of California haven't really been felt dramatically yet. We have fairly low weights, actually really low weights up front in hogs, which suggests that marketings are very current. So there's not a huge upfront supply in hogs. I think the hogs have more upside potential. And I like what we've done on the chart here in the last couple of days because we failed at resistance. The first time you tested after a big bounce off of lows like that, you would expect that to happen. It happened. We held support. And now we're kind of trading sideways and looking like we're going to bull flag here. I think we're getting ready for another leg higher. Now, I don't know if it's going to be sharply higher, but I think minimally we're going to go test those highs again.
All right. We'll see if we do. Thanks for joining us to Seifried Zaner Ag Hedge. That's Markets Now.